Question 1. A market maker's obligation under FINRA rules includes: A. Maintaining two-sided quotes for all securities traded on an exchange. B. Providing continuous, bona fide, two-sided quotes in the securities in which it makes a market. C. Executing all orders received, regardless of size or market conditions. D. Prioritizing proprietary orders over customer orders to maximize firm profits. Answer: B. Providing continuous, bona fide, two-sided quotes in the securities in which it makes a market. A core obligation of a market maker is to provide continuous, bona fide, two-sided quotes, meaning they must be willing to buy, bid, and sell, ask, a given security at all times during trading hours. This commitment ensures liquidity in the market by providing readily available prices for investors to trade. For example, if a market maker quotes XYZ stock at 20.00 to 20.10, they are obligated to buy at $20 and sell at $20.10 to anyone looking to trade. This continuous quoting is crucial for maintaining orderly markets, so always remember that a market maker's primary role is to facilitate trading through consistent price availability. Question 2. Under Regulation NMS Rule 611, the Order Protection Rule primarily aims to prevent: A. High-frequency trading firms from gaining an unfair advantage. B. Broker-dealers from internalizing customer orders. C. The execution of an order at a price inferior to a protected quote displayed by another market center. D. Trading ahead of research reports by affiliated firms. Answer: C. The execution of an order at a price inferior to a protected quote displayed by another market center. The Order Protection Rule, part of Regulation NMS Rule 611, mandates that trading centers establish procedures to prevent trade-throughs, which occur when an order is executed at a price inferior to a protected bid or offer displayed by another market center. For example, if a customer's order to buy a stock is routed to an exchange displaying an offer at $10.05, but another exchange has a protected offer at $10, the rule requires the order to be routed to the $10 offer first. This rule ensures that investors receive the best available price across all public markets, highlighting the importance of routing orders to the National Best Bid and Offer, NBBO. Question 3. Which of the following activities is specifically prohibited as a manipulative trading practice under FINRA rules? A. Legitimate hedging strategies to mitigate risk. B. Arbitrage trading across different markets. C. Spoofing, involving the entry of orders with the intent to cancel them before execution. D. Placing a large block order that is publicly displayed. Answer: C. Spoofing, involving the entry of orders with the intent to cancel them before execution. Spoofing is a manipulative trading practice explicitly prohibited by FINRA rules because it involves entering orders with the intent to cancel them before they are executed. This tactic artificially creates a false impression of buying or selling interest, tricking other market participants into reacting to phantom liquidity, for example, by placing a large buy order to make prices rise, then canceling it just before execution. Such behavior distorts market prices and undermines fair and orderly trading, making it a critical violation for traders to understand and avoid. Remember that market integrity relies on genuine trading interest, not deceptive signals. Question 4. A broker-dealer engaging in internalization of customer orders is permitted to do so provided they: A. Always prioritize their proprietary orders over customer orders. B. Execute the customer order at a price that is inferior to the National Best Bid or Offer, NBBO. C. Meet or beat the NBBO and provide best execution for the customer. D. Do not disclose their internalization practices to the customer. Answer: C. Meet or beat the NBBO and provide best execution for the customer. Internalization occurs when a broker-dealer executes a customer's order against its own inventory rather than routing it to an exchange. While permissible, the broker-dealer must still adhere to the best execution obligation, meaning they must execute the order at a price that is at or better than the national best bid or offer, NBBO, for that security. For instance, if the NBBO for a stock is 10.00 to 10.05, a broker-dealer internalizing a customer's buy order must fill it at $10.05 or lower. This practice ensures that even when a firm trades against itself, the customer still receives a fair and advantageous price. Question 5. Under SEC Rule 10b-18, a company repurchasing its own shares in the open market can benefit from a safe harbor from manipulation charges if certain conditions are met. Which of the following is not one of these conditions? A. Purchases are made through only one broker-dealer on any single day. B. Purchases are made at the beginning of the trading day. C. Purchases do not exceed 25% of the average daily trading volume, ADTV. D. Purchases are made at prices no higher than the highest independent bid or last independent transaction price, whichever is higher. Answer: B. Purchases are made at the beginning of the trading day. SEC Rule 10b-18 provides a safe harbor for issuers repurchasing their own stock, protecting them from manipulation charges if specific conditions are met. These conditions include limiting purchases to one broker-dealer per day, restricting the volume to 25% of the average daily trading volume, ADTV, and pricing purchases no higher than the highest independent bid or last independent transaction price. Purchases are specifically restricted during the opening and closing of the trading day, meaning purchases at the beginning of the trading day are generally not permitted within the safe harbor. This rule aims to prevent companies from artificially inflating their stock price through buybacks, so remembering the timing restrictions is key. Question 6. A locked market occurs when A. The best bid price is higher than the best offer price. B. A market maker fails to provide a two-sided quote. C. The best bid price equals the best offer price. D. Trading in a security is halted due to a circuit breaker. Answer: C. The best bid price equals the best offer price. A locked market occurs when the best bid price for a security is equal to the best offer price. For example, if one market participant is willing to buy XYZ stock at $50 and another is willing to sell it at $50, the market is locked. This situation is generally considered undesirable because it indicates a breakdown in efficient price discovery and can hinder immediate execution. While less common, it suggests that buyers and sellers are meeting at the same price point, which typically requires resolution under Regulation NMS to restore a spread. Question 7. According to FINRA Rule 5730, a market maker must promptly display a customer's limit order unless the order is A. A stop order. B. An odd lot order. C. A market on open order. D. A large block order. Answer: B. An odd lot order. FINRA Rule 5730, part of the consolidated FINRA rulebook, generally requires market makers to display customer limit orders that improve their published quote. However, there are exceptions to this Manning rule principle. Odd lot orders, defined as orders for less than a round lot, typically 100 shares, are specifically exempt from this display requirement. For example, a customer order to buy 50 shares at a specific price does not need to be displayed by the market maker, even if it improves their quote. This exception helps manage the volume of quotation traffic, so remember that small, non-round lot orders don't always need to be displayed. Question 8. An affirmative determination is required for which type of order? A. A market order to buy a security. B. A limit order to sell a security. C. A short sale order for a security. D. An order to buy a security on margin. Answer: C. A short sale order for a security. An affirmative determination is a requirement under Regulation SHO, which governs short sales. Before executing a short sale, a broker-dealer must make an affirmative determination that it has borrowed the shares or can reasonably expect to borrow them for delivery on settlement date. For example, if a customer wants to short 100 shares of ABC stock, the broker-dealer must confirm the availability of those shares to borrow. This rule aims to prevent naked short selling, which involves selling shares without arranging to borrow them, thereby helping to ensure orderly settlement and prevent manipulative practices. Question 9. Which of the following best describes the purpose of a dark pool? A. A fully transparent trading venue that displays all orders publicly. B. An alternative trading system, ATS, that does not display its orders publicly before execution. C. A market where only institutional investors can trade. D. A system for reporting trades after they have been executed on a primary exchange. Answer: B. An alternative trading system, ATS, that does not display its orders publicly before execution. A dark pool is a type of alternative trading system, ATS, that does not display its orders publicly before they are executed. Unlike traditional exchanges, dark pools allow institutional investors to trade large blocks of shares without revealing their intentions to the broader market, which helps minimize market impact. For example, a large institutional investor wanting to buy 1 million shares of a company might use a dark pool to avoid driving up the price by publicly displaying such a large order. These venues offer anonymity and price improvement opportunities, but their lack of pre-trade transparency is a key distinguishing characteristic. Question 10. Under SEC Rule 605, market centers must publicly disclose monthly reports summarizing A. The firm's annual financial performance and profitability. B. The quality of their order executions, including speed, price improvement, and fill rates. C. All complaints received from customers during the month. D. Details of all proprietary trading activities conducted by the firm. Answer: B. The quality of their order executions, including speed, price improvement, and fill rates. SEC Rule 605 requires market centers to publish monthly reports summarizing the quality of their order executions for covered orders. These reports provide metrics such as effective spreads, realized spreads, price improvement, and fill rates, broken down by order size and type. For instance, a report might show how often market orders received price improvement compared to the best available quote. This transparency allows investors and broker-dealers to compare execution quality across different market centers, empowering them to make informed decisions about where to route orders. Question 11. FINRA Rule 5710 generally prohibits a member firm from trading for its own account in a security if the firm has A. Received an unsolicited customer order in that security. B. Undisclosed material, non-public information about that security. C. Acted as an underwriter for the security in the past 5 years. D. A large long position in the security. Answer: B. Undisclosed material, non-public information about that security. FINRA Rule 5710, concerning insider trading, prohibits a member firm or any person associated with it from trading for its own account while in possession of undisclosed material, non-public information about a security. This rule is designed to prevent unfair advantage and maintain market integrity. For example, if a firm learns that a company is about to announce a major acquisition before it's public, trading on that knowledge would be illegal. This prohibition is fundamental to preventing market manipulation and ensuring a level playing field for all investors. Question 12. A wash sale is a manipulative practice characterized by A. Selling a security for a loss and repurchasing it within 30 days to harvest tax benefits. B. Entering orders to buy and sell the same security at the same time and price with the same beneficial ownership. C. Buying a security and then selling it at a higher price to a different party. D. The process of liquidating an entire securities portfolio. Answer: B. Entering orders to buy and sell the same security at the same time and price with the same beneficial ownership. A wash sale, in the context of manipulative practices, refers to the simultaneous or nearly simultaneous entry of orders to buy and sell the same security by the same beneficial owner, with no genuine change in ownership or market risk. This practice is manipulative because it creates the appearance of trading activity without any real economic purpose, potentially misleading other market participants about supply, demand, or price. For example, a trader might enter a buy order for 1,000 shares of XYZ at $50 and a sell order for 1,000 shares of XYZ at $50, with both orders originating from the same ultimate owner. This artificial activity is prohibited as it can falsely influence trading volumes and prices. Question 13. Which of the following best describes the primary goal of the sub-penny rule, Regulation NMS Rule 612? A. To prevent market makers from quoting in sub-penny increments. B. To ensure all orders are executed at whole dollar increments. C. To allow market participants to quote and trade in increments smaller than a penny. D. To require all trades to be reported in fractions of a penny. Answer: A. To prevent market makers from quoting in sub-penny increments. The sub-penny rule, Regulation NMS Rule 612, prohibits market participants from accepting, ranking, or displaying bids or offers in increments smaller than 1 cent for NMS stocks priced at $1 or more. Its primary goal is to prevent the excessive fragmentation of liquidity and to ensure meaningful price discovery by limiting the minimum tick size. For example, a stock trading at $25 cannot have a bid of $24.991, the minimum increment must be 1 cent. This rule aims to create a more orderly and accessible quoting environment for all participants. Question 14. Under SEC Rule 15C2-11, a broker-dealer generally cannot publish quotations for a security unless A. The issuer has been trading publicly for at least 1 year. B. The broker-dealer has current public information about the issuer. C. The broker-dealer is also a registered market maker in the security. D. The security is listed on a major national securities exchange. Answer: B. The broker-dealer has current public information about the issuer. SEC Rule 15C2-11 generally prohibits a broker-dealer from publishing quotations for an OTC equity security or a fixed income security unless specific information requirements about the issuer are met. The rule mandates that the broker-dealer have current public information about the issuer, such as financial statements and business descriptions, and that this information is reasonably available to investors. For example, a broker-dealer cannot just start quoting a previously untraded or thinly traded stock without ensuring they have reviewed and can make available the necessary company disclosures. This rule is designed to ensure transparency in the OTC markets and protect investors from fraudulent or speculative activities by requiring information to be current and accessible. Question 15. A member firm is required to report transactions in trace-eligible securities to the Trade Reporting and Compliance Engine, TRACE, within A. 1 business day. B. 3 business days. C. 15 minutes of execution. D. 1 hour of execution. Answer: C. 15 minutes of execution. For trace-eligible securities, which primarily include corporate and agency bonds, FINRA rules require member firms to report transactions to the Trade Reporting and Compliance Engine, TRACE, within 15 minutes of execution. This rapid reporting ensures transparency and allows for the dissemination of real-time pricing information in the bond market. For example, if a firm executes a bond trade at 10 a.m., the details must be submitted to TRACE by 10:15 a.m. Timely reporting is crucial for market efficiency and for providing current bond prices to investors. Question 16. What is the primary purpose of FINRA's Rule 5130? A. To regulate the trading of options contracts. B. To restrict broker-dealers from making a market in certain OTC equity securities. C. To ensure that public offerings of new issues are made available to the public and not disproportionately allocated to industry insiders. D. To establish best execution standards for customer orders. Answer: C. To ensure that public offerings of new issues are made available to the public and not disproportionately allocated to industry insiders. FINRA Rule 5130, often referred to as the New Issue Rule, is designed to ensure that public offerings of new issues, IPOs, are genuinely offered to the public and not allocated to restricted persons, such as FINRA member firms, their employees, or immediate family members of associated persons. Its primary purpose is to prevent conflicts of interest and ensure a fair and widespread distribution of new issues. For instance, a registered representative cannot buy shares in an IPO from their own firm. This rule aims to prevent spinning and other preferential allocations that would unfairly benefit insiders. Question 17. The primary goal of FINRA's best execution rule is to ensure that a. Broker-dealers route all customer orders to the market center with the highest volume. b. Customers always receive the lowest possible commission fees. c. Broker-dealers use reasonable diligence to ascertain the best market for a security and buy or sell in that market so that the customer receives the most advantageous price. d. All customer orders are executed immediately, regardless of price. Answer: C. Broker-dealers use reasonable diligence to ascertain the best market for a security and buy or sell in that market so that the customer receives the most advantageous price. The primary goal of FINRA's best execution rule is to obligate broker-dealers to use reasonable diligence to determine the best market for a security and then execute customer orders in that market to ensure the customer receives the most advantageous price reasonably available. This involves considering factors like price, speed of execution, likelihood of execution, and order size. For example, if a customer wants to buy XYZ stock, the broker-dealer must search available venues to find the lowest offer, even if it means routing to an away market. Always remember that best execution is about securing the most favorable terms for the customer under prevailing market conditions. Question 18. What is front-running? A. Placing a customer order before a proprietary order. B. Placing an order for a security based on an analyst's publicly released report. C. Placing a proprietary order to take advantage of material non-public information regarding an impending customer order. D. Executing a trade ahead of a previously placed limit order. Answer: C. Placing a proprietary order to take advantage of material non-public information regarding an impending customer order. Front-running is a prohibited manipulative practice where a broker-dealer or a person associated with it places a proprietary order, for its own account, or a related party's order to take advantage of material non-public information concerning an impending customer order. For example, if a broker-dealer knows a large institutional client is about to place a massive buy order that will likely drive up the stock price, and the broker-dealer buys shares for its own account beforehand, that is front-running. This practice is illegal because it exploits a customer's market impact for the firm's benefit, undermining the duty of best execution and market fairness. Question 19. Under FINRA rules, a bona fide market maker is required to A. Execute all orders received at its published quotes. B. Maintain continuous two-sided quotes and engage in genuine market-making activities. C. Prioritize its proprietary trading profits over all other considerations. D. Only make markets in securities listed on national exchanges. Answer: B. Maintain continuous two-sided quotes and engage in genuine market-making activities. A bona fide market maker is required to maintain continuous, two-sided quotes in the securities in which it makes a market and to engage in genuine market-making activities. This means they are truly committed to providing liquidity by being ready to both buy and sell, rather than just selectively quoting. For example, a bona fide market maker in XYZ stock will consistently display both a bid price, to buy, and an offer price, to sell, throughout the trading day, even in volatile conditions. This ensures that the market has depth and that investors can reliably transact their shares. Question 20. Which entity is primarily responsible for regulating the trading of options contracts? A. The Municipal Securities Rulemaking Board, MSRB. B. The Securities and Exchange Commission, SEC, and the Options Clearing Corporation, OCC. C. The Federal Reserve Board, FRB. D. The National Futures Association, NFA. Answer, B. The Securities and Exchange Commission, SEC, and the Options Clearing Corporation, OCC. The primary regulatory authority over the trading of options contracts falls under the Securities and Exchange Commission, SEC, which oversees securities markets, and the Options Clearing Corporation, OCC. The OCC acts as the sole issuer and guarantor of all listed options, ensuring performance and standardizing contracts. While FINRA sets rules for broker-dealers involved in options trading, the SEC and OCC hold the primary regulatory and clearing responsibilities. This multi-layered oversight helps ensure the stability and integrity of the options market. Question 21. What is the maximum volume of shares a broker-dealer can purchase under the safe harbor provisions of SEC Rule 10b-18 for an issuer's share repurchase program, assuming specific ADTV conditions are met? A. 10% of the average daily trading volume, ADTV. B. 25% of the average daily trading volume, ADTV. C. 50% of the average daily trading volume, ADTV. D. Unlimited, as long as it's for legitimate corporate purposes. Answer, B. 25% of the average daily trading volume, ADTV. Under SEC Rule 10b-18, one of the key conditions for an issuer's share repurchase program to qualify for the safe harbor from manipulation charges is a volume limitation. The issuer's total purchases on any single day, excluding block purchases, must not exceed 25% of the average daily trading volume, ADTV, for the security. For example, if a stock's ADTV is 100,000 shares, the company could purchase up to 25,000 shares, excluding block trades, without losing the safe harbor protection. This limit helps prevent the issuer from dominating the market and artificially inflating its stock price. Question 22. Which of the following is a key characteristic of an intermarket sweep order, ISO? A. It must be executed in full at a single market center. B. It is priced at a sub-penny increment to gain priority. C. It is a limit order that simultaneously routes to sweep all accessible protected quotations at its limit price. D. It can only be used by market makers, not retail investors. Answer, C. It is a limit order that simultaneously routes to sweep all accessible protected quotations at its limit price. An intermarket sweep order, ISO, is a specific type of limit order that is used to bypass the trade-through rule of Regulation NMS Rule 611. An ISO allows a market participant to simultaneously route orders to sweep all accessible protected quotations at its limit price or better. This effectively allows an order to be executed at a price inferior to a protected quote if all better-priced protected quotes have been simultaneously accessed. For example, if you want to buy XYZ stock at $10 but there are better offers at $9.95 on other exchanges, an ISO would route simultaneously to all $9.95 offers while also executing at $10. This is useful for large orders that need immediate execution across multiple venues. Question 23. A broker-dealer's obligation to maintain records of communications related to trading is a requirement under A. The Investment Advisors Act of 1940. B. The Securities Exchange Act of 1934 and FINRA rules. C. The Sarbanes-Oxley Act of 2002. D. The Uniform Securities Act. Answer, B. The Securities Exchange Act of 1934 and FINRA rules. Broker-dealers are required to maintain comprehensive records of communications related to their trading activities primarily under the Securities Exchange Act of 1934 and various FINRA rules. These regulations mandate the retention of emails, instant messages, and other forms of electronic and written communication to ensure compliance, surveillance, and investigatory capabilities. For instance, any chat conversations between traders about an order must be captured and stored. This extensive record-keeping is crucial for regulatory oversight, helping to detect market manipulation, insider trading, and other violations. Question 24. A broker-dealer acts as a riskless principal when it a. Takes a position in a security for its own account with the intent of profiting from price changes. B. Purchases a security from a customer into its inventory before finding a buyer. C. Simultaneously buys a security from a customer and sells it to another customer, without taking on market risk. D. Facilitates a trade between two customers by matching their orders as an agent. Answer: C. Simultaneously buys a security from a customer and sells it to another customer, without taking on market risk. A broker-dealer acts as a riskless principal when it simultaneously buys a security from a customer and sells it to another customer, or another market participant, without taking on market risk for its own account. In this scenario, the firm essentially facilitates the trade by taking title to the security momentarily to complete the transaction, but it has a prearranged buyer and seller. For example, if customer A wants to sell XYZ stock and customer B wants to buy it, the firm might buy from A and immediately sell to B, charging a markup/markdown. This differs from agency trades where the firm acts as a pure broker or principal trades where the firm takes on inventory risk. Question 25. Which of the following is a primary characteristic of a matched order as a manipulative trading practice? A. An order placed at a price away from the current market to indicate interest. B. An order to buy or sell a security that is immediately followed by a matching order on the opposite side, entered by the same or conspiring parties. C. A large block order that is broken into smaller pieces to avoid market impact. D. A series of legitimate trades executed to establish a specific price point. Answer: B. An order to buy or sell a security that is immediately followed by a matching order on the opposite side, entered by the same or conspiring parties. A matched order is a manipulative trading practice characterized by a buy or sell order for a security that is immediately followed by a corresponding matching order on the opposite side, typically entered by the same person or by different parties acting in concert. This creates the false appearance of active trading interest and volume, misleading other market participants about the security's demand or supply. For instance, person A places a buy order, and simultaneously, person B, conspiring with A, places a sell order for the same quantity and price. This artificial activity is prohibited because it distorts market prices and gives a false impression of market depth.